Hi everyone, we're continuing our video series for aspiring entrepreneurs who have a business idea but don't know where to start or how to begin gathering the data needed to build a financial model. So far, we've published videos on how to collect input data for the following sections of a financial model: pricing strategy, sales plan, investment plan, and fixed costs. You'll find links to those videos in the description below. Today, we're going to talk about direct costs. In the comments below, feel free to share your suggestions about what else entrepreneurs should consider when gathering the input data needed to build a financial model for their business idea. Our goal is to turn this video series into an open encyclopedia for aspiring entrepreneurs, people who have a great business idea but don't know where to begin. So subscribe to our channel. There's a lot of valuable and practical content coming your way. We have been developing business plans and financial models for 20 years, and in the upcoming videos, we'll cover topics such as payroll planning, production planning, financing sources, and much more. Now, let's move on to direct costs. As always, let's begin with a definition. Direct costs are expenses that increase when revenue increases and decrease when revenue decreases. In other words, there is a direct relationship between this type of expense and revenue. It is very important to emphasize this point. So the very first thing you need to do is compile a complete list of all your project's expenses and classify them into fixed costs and direct variable costs. This is your starting point, the identification and classification of direct and fixed costs. Next, for each direct cost item, you must identify the specific cost driver it is linked to. That driver could be the number of customers, machine operating hours, units produced, units sold, or any other factor that directly determines the expense. Today, we'll take a detailed look at the different types of direct cost drivers. One more important fundamental point. If you have a manufacturing project, you should model your production processes in the financial model first. These processes will later serve as the cost drivers for your direct costs. In other words, before calculating cash flows, you should model the entire production cycle, including its processes, material losses, and operational specifics. Only after that should you assign the financial values to those processes. This is the most effective and accurate approach. The first cost driver is units sold. In other words, you need to identify all the costs that are directly linked to each unit of product sold. The second cost driver is units produced. As you can imagine, units sold and units produced are not the same thing. For part of the year, you may be producing primarily for inventory while selling relatively little. Then, when the busy season arrives, you may sell more than you produce because you'll also be selling products from the inventory you built up during the off-season. Some direct costs will depend on the number of working days in each month. If your business is seasonal, this parameter can easily become a key cost driver for certain direct costs. The number of operating shifts is another important direct cost driver. Some direct costs will depend on whether your factory operates 1, 2, or 3 shifts. You need to identify which direct cost items are linked to this particular driver. Direct costs can also be linked to production cycles. For example, they may depend on a wood drying cycle, a brick firing cycle, a finished product painting cycle, or any other production process with a defined operating cycle. Next, direct costs can also be linked to the number of customers in your business at any given point in time. Sometimes, a certain portion of direct costs is linked not to all customers, but only to new customers who become your clients during a specific month. It can also happen that your staffing levels grow according to a specific ratio. For example, for every 5 new customers, 1 additional customer service manager is added. Direct costs can also be linked to the operating hours of a production line. They may depend on the operating hours of the entire production line, or, for example, on a specific part of the line. To do this, as we have already discussed, you need to model the production process first so that this type of direct cost can be linked to the correct parameter within the production process. Payroll can also be considered a direct cost. A certain portion of payroll, such as office employees, will be included in fixed costs, while production personnel who are paid on a piece rate basis will represent classic direct costs. There are also simple situations where direct costs can be calculated as a fixed percentage of revenue. This approach is used relatively rarely, but it does happen. Direct costs can also be linked to raw materials, supplies, energy resources, and other inputs required to produce a product. These may include raw materials, components, water, gas, electricity, square meters, linear meters, liters, cubic meters, and other types of resources that are consumed at different stages of the production cycle in order to manufacture the finished product. All of these factors must be carefully considered and correctly linked to the appropriate cost drivers. Today, we reviewed the process of collecting input data related to the direct costs of your business idea. As always, we started with a definition. We established that the first step is to create a complete list of all expenses and divide them into fixed costs and variable costs. Next, for each direct cost item, we need to identify its cost driver. If you have a manufacturing business idea, you need to model the production cycle first. This is the foundation of the entire model. This should be done before calculating cash flows. A cost driver can be units sold or units produced. These are not the same thing. A cost driver can also be the number of working days in a month or the number of operating shifts. Different production cycles can also serve as cost drivers. Direct costs can be linked to the number of customers your business has at a specific point in time, or only to the number of new customers who joined your business during a particular month. They can also depend on the number of operating hours of a production line. We discussed that payroll can be either a fixed cost or a variable cost. There are also rare but simple situations where direct costs can be calculated as a percentage of revenue. And of course, direct costs can be linked to the consumption of various raw materials and energy resources required to manufacture finished products. In the comments below this video, you can share your additions and suggestions regarding the collection of input data. We want to turn this video series into an open encyclopedia for aspiring entrepreneurs who have a business idea but don't know where to start. We have been developing business plans and financial models for 20 years. Links to the videos about collecting input data can be found in the description. Coming up, we will publish videos about collecting input data for such sections as payroll, project financing, production planning, and many other important topics. So subscribe to our channel. It will be very interesting and educational. See you in the next video.